5 effective ways to take advantage of a stock market crash. Market crashes are inevitable. The idea is to prepare for them rather than be concerned about them. Long-term investors have long known how to profit from a stock market slump. According to research, stock market crashes are unavoidable over time. After peaking at $4,796.56 on January 3, 2022, the S&P 500 entered in a bearish run and finished at $3,674.84 on June 17, a 23% fall. Geopolitical tensions in Europe, rising inflation and interest rates, and supply chain restrictions all contributed to the market's decline. However, the recent market crash in the first half of 2022 is just one of many that have occurred and will occur in the future to differing degrees. Consider how many bear markets have occurred in the last 50 years. As a wise investor, you should not only expect bullish runs, but also bear markets with specific attention paid to how to profit from a stock market drop. In other words, you must consider what to do and how to react when the stock market drops. If you're going to invest in equities or real estate for the long term, there will be moments when there's a lot of suffering and other years when there's a lot of boom, said Charlie Munger, vice chairman of Warren Buffett's conglomerate Berkshire Hathaway. I suppose you just have to learn to live through them. In this post, we will look at 5 strategies to profit from a stock market meltdown for the purpose of your financial goals. 1. Use dollar cost averaging. Dollar cost averaging is an investment technique that spreads out a certain amount of money over a set period of time. So, if Mr. A has $10,000 and decides to invest $1,000 at the end of each month for the next 10 months, he is averaging his money. This investment strategy is frequently used by new investors who are unfamiliar with the market. However, it is also a fantastic technique for individuals who are hesitant to deposit a large sum in the market at once. During stock market falls, dollar cost averaging is also a smart strategy. How so, you could ask? When the stock market falls and stock prices fall, you have the opportunity to purchase them at a lower price. For example, if stock A is worth $100 at the end of January and $80 at the end of February, investor A can and should buy them cheaper in February using a DCA method. Stock market crashes provide opportunities for dollar cost averaging investors to obtain more shares for the same price and reduce the average cost of investing in a stock. Consider the previous example of Mr. A, who decided to spread his $10,000 across 10 months at $1,000 each month. Assume that at the end of January, stock A was worth $100 per share, $80 at the end of February, and $50 at the end of March. He would receive 10 shares, $1,000/100 in January, 12.5 shares, $1,000/80 in February, and 20 shares, $1,000/50 in March. That is, the same $1,000 would have bought him more shares in February and March just because the market was down. Similarly, instead of the original $100, $1,000/10 shares, his average cost of investing in stock A is now $70.06, $3,000/42.5 shares. Mr. A was not required to perform anything in the preceding case. He only needed to keep investing consistently using a dollar cost averaging strategy, and now, as a result of the market slump, he has more shares at a lower average cost. DCA versus market avoidance versus buying the decline. This method of dollar cost averaging is better to maintaining cash during stock market crashes. Why? Because of inflation, your cash will be worth less by the time the market fall is done. Investing in the market, rather than keeping cash that loses actual value, has the ability to get investors more shares for the same dollar amount and lower the average cost of a position in a stock. Similarly, dollar cost averaging is preferable to buying the dip. Because no one knows when the market has genuinely bottomed, even skilled analysts can never be certain. If you wait for the dip, you will miss out on opportunities to purchase more shares for the same dollar amount and lower your average cost through dollar cost averaging. Furthermore, if the dip continues to fall, you will continue to lose money. If you sell out of fear and the market begins to correct, uptrend, you will lose your profit and must re-enter the market at a higher price. No surprise, according to Callie Cox, senior investment strategist at Ally Invest, buying the drop is one of those things that works incredibly well on paper, but doesn't perform well in real life. Dollar cost averaging is a wonderful approach to avoid the hassles of purchasing the dip. 2. Acquire dividend stocks. Buying dividend stocks is another strategy to profit from a stock market slump. Dividend stocks are those that have continuously paid dividends for a set length of time. Dividend aristocrats are dividend companies that have paid dividends regularly for at least 25 years, and dividend kings are dividend stocks that have paid dividends consistently for at least 50 years. So why are dividend stocks beneficial during market downturns? A stock can be profitable in two ways: dividends and capital appreciation. A dividend, as opposed to capital appreciation, which occurs when you sell the shares at a premium, is a consistent quarterly payment of cash. Even during market downturns, most dividend companies, particularly aristocrats and kings, continue to pay dividends. Because they are already at the maturity stage of their business life cycle, these companies frequently generate consistent revenue and earnings. As a result, they can withstand inflationary or recessionary pressures and even raise prices due to competitive advantage. So, the first reason to buy dividend stocks is that they provide a hedge against inflation and are less susceptible to stock market crashes than the broader market. For example, although the S&P 500 index dropped by 23% between January 3 and June 17, 2022, the S&P 500 Dividend Aristocrats Index only fell by 16% during the same period. Second, most dividend stocks will continue to pay dividends even if the market falls. This is money that you can withdraw or reinvest in the market to buy additional stock and lower your average cost, as with DCA. Furthermore, during inflationary periods, some of these dividend stocks increase their dividend distributions since they can raise their prices and receive more cash from their sales, offering a hedge against inflation. Large companies with a long history of paying reliable dividends each year have an advantage in an inflationary environment. They can weather and even benefit from higher pricing, according to CNBC. 3. Think about reevaluating your portfolio allocation. Just as some sectors of the economy outperform during bullish runs, others outperform during negative periods. If your investment style is more aggressive, you might want to reconsider your portfolio allocation. If you are a passive investor, you should stick to your portfolio allocation approach even if the market is down. Consumer staples, healthcare, and utilities are three sectors that have typically performed better during market downturns. This is due to the fact that the items and services in these sectors, food, beverages, pharmaceuticals, hospital visits, power, water, and gas, are all weather requirements, and people continue to spend money on them even when the economy is bad. As a result, while the S&P 500 index dropped by 23% between January 3 and June 17, the S&P 500 Consumer Staples Sector Index fell by only 11.5%. The S&P 500 Healthcare Sector Index fell by 14.4%, and the S&P 500 Utilities Sector Index fell by 9.2%. The Nasdaq Composite Index, which includes largely technology stocks, dropped 31.8%. Instead of quitting the market, you can shift your investments from less immune sectors, such as technology, to ones that are more resilient to the crash, consumer staples, for example. And when things improve, you may reevaluate. ETFs make sector rotation easier to implement. An ETF is a collection of securities that includes a number of stocks or bonds. As a result, if you invest in a sector through a single ETF rather than 10 or 20 equities, it is far easier and less expensive to sell one ETF and buy another rather than finding, purchasing, and selling several companies in a sector you may not be totally familiar with. 4. Diversify with bonds. Market crashes provide opportunities to diversify your portfolio beyond stocks if it is not already. Bonds benefit every portfolio. They provide a cushion when the stock market falls, said Suze Orman, founder of Suze Orman Financial Group. Bonds provide this protection since they are less volatile than equities. And while the recent 2022 downturn witnessed bond market volatility, maintaining a weighted portfolio with a good allocation of bonds, at least 20%, has historically helped decrease overall risk. Many analysts still see government bonds as very low-risk assets, which means you can be more confident that they will pay. Even corporate bonds, which are riskier than government bonds, are significantly less risky than equities. Bonds are generally chosen in market crashes because of their safety, making them more desirable regardless of why the market is down. That is, their prices might rise during stock market collapses and fall during stock market crashes. You can thus profit from a stock market fall by investing in bonds and riding the bond market's wave. 5. Become a long-term investor. Market crashes can and do occur, but they do not continue indefinitely. To date, a period of recovery/correction has always followed. Those who are patient and stay invested during market downturns are the same people who will benefit when market corrections come. In contrast, those who abandon the stock market to avoid a drop are odds-on favorites to miss the next surge, according to Peter Lynch, a renowned investor and former Fidelity Investments fund manager. Taking advantage of the recovery following the fall necessitates a long-term investing mindset, as well as the capacity to spend time in the market rather than time the market. According to the Center for Research in Stock Prices, CRSP studies, the market increases more than it declines, as indicated in the graph below. As a result, people that stay in the market rather than entering and exiting frequently will earn higher long-term profits. Between 1926 and 2019, the CRSP US Whole Stock Market Index performed well. Those who timing the market, on the other hand, may lose out on the market's best days while participating in its worst days. Those that stay in through it all, on the other hand, have a better chance of profiting because the market rises more than it falls. You can build a diversified portfolio of dividend stocks, all-weather companies in the consumer staples, healthcare, and consumer staple sectors, and bonds if you are a passive investor. You might also consider employing dollar-cost averaging to invest in such a portfolio. You can be confident in market collapses with a diverse portfolio even if you don't change your portfolio. That is, rather than worrying about what would happen if the stock market crashed, you may prepare for it ahead of time. Finally, whether passive or active, the goal is to remain in the market for the long run. The stock market is a vehicle for transferring money from the impatient to the patient, Warren Buffett said. Please be patient, my friend. That's all, guys. I hope you enjoyed watching this video. Remember to subscribe and give a thumbs up to this video. Thank you for your time.